Welcome to Markets Plus from BMO Capital Markets and another episode of the Hedge Report. I'm Cheryl Ferguson, Managing Director in Global Markets. In this series, we break down the latest market trends and strategies to help you manage interest rate and foreign exchange risk. Hi, everyone. Today, we're taking a closer look at the Canadian economic outlook, what we're seeing from the Bank of Canada, what economic data is signaling, how global dynamics like USMCA and geopolitical tensions are feeding into the outlook, and importantly, what it all means for hedging interest rate risk right now. I'm joined again by Ben Reitzes, Managing Director and Canadian Rates Macro Strategist. Ben, great to have you back.
Thanks for having me, Cheryl.
Let's start with the Bank of Canada. We've seen softer CPI, softer GDP, but a healthy employment report last week. How are you thinking about the current state of the Canadian economy?
So there's a lot of discussion about how weak the economy is at the moment, and that narrative is really dominating at the moment. And lots of discussion around whether Canada's in recession. We've had back-to-back negative GDP prints, the fourth quarter and the first quarter, which a lot of people say is a technical recession. While that is a rule of thumb, rule of thumbs are not always right. This would be one of those cases. We don't have the breadth, depth of contraction in the economy to say this is recession. The Bank of Canada agrees with that view. They made that pretty clear at their meeting this week. The economy is really in a place where kind of where we've been for the past 18 months or so. The trade uncertainty has really been weighing on growth and sentiment for that entire period. And we've seen very uneven growth. So you have a good quarter, then a bad quarter, good, bad, back and forth, and very uneven numbers. And Canada's really having trouble gaining traction from a momentum perspective, and I like to say the economy is just kind of meandering along. Like there's nothing super positive, but at the same time, we're not really falling off a cliff either. So we're hanging in there, waiting for something positive to happen to kind of gain that momentum. I think that will be a trade deal when that trade deal comes. Until then, probably more of the same, back and forth, bunch of bad numbers, bunch of good numbers, and on we go, just repeating that cycle.
So against that backdrop, how is the Bank of Canada thinking about policy? Let's start there. I know at the meeting this week with the central bank, they had mentioned we may cut interest rates and we may hike interest rates. So directionally, I think it's very difficult for clients to determine what is happening in the interest rate market if our central bank is finding it quite difficult. Can you speak to those points?
Sure. Well, they have three options. They can cut, they can hold, or they can hike. So they've outlined all three of those just to make it extra fun. They are in a challenging spot. So you have the economic backdrop that I mentioned. Generally weak growth. The economy has what they like to call an output gap. So there is excess capacity in the economy, which puts downward pressure on prices, and we've seen that have some impact in the core inflation numbers. But at the same time, we have the war in Iran, and that's pushing up oil prices, and prices are still, even if they're well off the highs, they're still well up from where they were pre-war, and that means upward inflation pressure. And from the Bank of Canada's perspective, after living through the latest inflation spike that everyone has dealt with, including Canada, they don't want to repeat that. Their credibility is at risk from that perspective. And so while there are plenty of reasons for them to be dovish and for lots of people to say that they should pull rates lower, the reality is they're as much, if not more, afraid of higher inflation, and that really taking hold in the Canadian psyche and changing inflation dynamics in Canada and inflation expectations, that they have no interest at the moment in fanning those inflation flames. They just don't want to pull rates lower. So they've warned of rate hikes. Quite frankly, that's a little bit far-fetched at this point. That growth backdrop is not one in which you want to raise rates. There is a world in which they could. Sure, oil prices go up a ton from here. Inflation passes through broadly to other items beyond just energy. Yeah, they could raise rates in that environment, and they would. But at this point, the way the energy market trades, the way the oil market trades is not indicative of a market wanting to push a lot higher. And so as long as that oil market remains relatively contained the way that it has, there's no real reason to think that you're going to get broad-based inflation pressures causing the bank to raise rates. So we have them on hold through the rest of this year. I think I'm pretty firm in that for now. Beyond that point is a little bit more uncertain.
Is it fair to say the market is pricing in one hike before the end of calendar year?
They sure are. We've priced in as many as 4 hikes at one point for this year. And it's indicative of a market where the bank, one, has made it clear again, they don't really want to be cutting, that they are cognizant of the risks there. There's more than just the inflation side. There's also housing. There's a whole bunch of other things we could talk about if you'd like. And global central banks are also pushing rates higher. So we had the European Central Bank raise rates today. And globally, that is the way pretty much every central bank is priced, including the Federal Reserve now. And so there's no reason for Canada to be any different. And again, the bank has made it clear that unless things really fall apart and oil collapses also, the rates aren't going down. So if the risks are tilted toward a hike, which they seem to be, then that's the way you price the market.
Let's shift to trade. I know you mentioned USMCA is back in focus, particularly yesterday when Trump announced he is not going to have a deal with Canada or Mexico. And it could be a year by year.
Hold on. Yes. It's important to explain what those headlines actually mean.
Sure. Go ahead.
So when he's like, we're not going to renew USMCA, there are a number of different options the way this can go. So by renew, he means we're not going to extend it by 16 years. So if you renew it without any changes, it goes as is for 16 more years. So that's not happening. We already knew that. That is not news. It's great to have headlines and our Bloomberg terminals flash red with all sorts of things, but a lot of the time it's nonsense. This would be one of those cases. What ends up happening is, assuming it doesn't renew, which obviously it's not, we go through a year-by-year process where negotiations are effectively permanently open. So it is a permanent negotiation until we get a deal. The current status quo lasts 10 more years. So well beyond Trump's timeline in the White House. I've been on this for a while, and I'm not necessarily joined by all of my colleagues, but I'm optimistic on a deal. I think it makes sense from everyone's perspective. Trump likes to play hardball. He likes to talk a lot of smack, and talk does not mean anything to me. Their actions speak a lot louder than words, and their actions are positive. Their actions point to a deal coming.
Yeah, and I just don't know if that's really exactly how the general public digests all of the headlines, because I would say we get a lot of headlines and the market reacts to some of those and not some. So yeah, when you're watching the evening news, sometimes it's difficult to kind of decipher what exactly these headlines mean.
The headlines are definitely challenging, and the way in which the U.S. is currently viewed in Canada makes that even more challenging, because there is generally a slant on the views on how we view the U.S., which is not ideal. And actually, Bank of Canada Governor Macklin made this point yesterday. There have been small signs that businesses in particular are starting to figure out how to deal with this uncertainty, or just deciding that, like, you know what, it's been a year. I'm not going to sit on my hands forever. At some point, you have to pick a path forward and move and go in that direction. And so there was a little bit of that in the Bank of Canada's January Business Outlook survey. Then the war broke out and you got more uncertainty on energy prices. And so that kind of stalled things out a little bit. But there are signs, I think, that we can still move forward even if we don't get a firm trade deal. I still think we're going to get one at some point. The timing is the hard part on this. It is in everybody's interest to get a deal done. It's just a question of how much Canada and Mexico need to give up to do that. And I would guess it's probably not as much as we think, but I've been known to be wrong.
Speaking of headlines, how are you thinking about the tensions in the Middle East? I think we're more than a few weeks in now. How do you feel that these tensions in the Middle East are affecting the macro backdrop?
Well, it's just about energy prices. The war itself is, from a market perspective, only as relevant as the Strait of Hormuz is open or closed. That's all that matters. Everything else is kind of irrelevant. And it seems as though, like, as long as energy prices remain kind of contained here, like we learned yesterday that there are oil tankers going through the strait every day for the past little while, and they've moved 100 million barrels of oil, or so said President Trump, but it's a few million barrels a day, which is not what it was. But with the other impacts of higher oil demand destruction, China is consuming significantly less, importing significantly less. I don't know if they're consuming less, but they're importing less. That has enabled energy prices to stay contained. And that's why we're in the low 90 range in WTI versus we were as high as 120-ish almost was the high. So if we can stay here, things probably remain relatively contained. It's just a question of the risks of things getting worse or not. And it looks as though the U.S. has had enough of negotiations going nowhere, and so we get some attacks last night, a little bit more today. We'll see how Iran responds. I think that'll be a great question. Is Iran going to attack the infrastructure in the region or just focus on retaliating against the U.S.? That probably goes a long way to determining where this goes. If they damage some of the energy infrastructure, that would cause a much larger problem. The next 24 hours, 48 hours, I'm not sure how long this little skirmish goes for, but that's what I'll be looking for.
A lot happening out there.
There's a lot happening all the time. That's what makes my job fun.
It seems there is a lot more happening these days from a historical perspective, but we've got policy uncertainty, both Canada and the U.S. Generally, softer data here in Canada, some strength showing up, global risks, and a lot of intraday volatility with respect to interest rates and FX. You talk to a lot of clients day over day as well, both investors and issuers. How are clients feeling about current macro environment?
It is a low conviction environment. There are very few trends to follow. Investors like to follow trends. Trends make life easy. Things go in one direction for a while. They can retrace a little bit, but it's going that way, and that's not where we are at the moment. I think we're hoping that we get some kind of bigger narrative to drive rates in one direction or the other, and then we can kind of latch onto that and ride it for as long as we can. But it's a challenging market, and that's how everybody sees it. And one of the issues is the headlines really drive things a lot. And when you walk in one morning and let's say you get a great job number 1 hour and then the next hour
missiles are being fired.
Yes, something else happens that makes the market go the total other way. And it's just, okay, how do you do this? You have a macro backdrop and that's great. And that can inform your investment decisions. But there are other factors moving rates. There are other factors moving risk assets. And you really just can't know which shock is coming next. And people have been as nimble as they can be. And that's really been, I think, the defining characteristic. And for Canada, it's probably been longer lasting than that, more than a year or so, because like the bigger macro picture has been clouded by trade this entire time. And so it's made things really hard. And so low conviction for some time.
Yeah, it's clients just in chatting with the issuer side, with all this uncertainty that's been out there, quite frankly, as you mentioned, since April 2025, it's difficult to remove the pressure to react to every headline and shift from trying to predict the market to having something more disciplined when it comes to hedging. How do you think clients should think about balancing protection with flexibility? And second question, let's get your thoughts on interest rates for the next 6 to 12 months in Canada, both short-term and long-term interest rates, and again, beyond 12 months.
It's a different question for me. It's a different market for the issuer side than for the investor side. Very different, I would say. We are in a period where even though we have all of these risks and all of this uncertainty, credit spreads are ridiculously tight. Risk is very bid. Stocks are close to all-time highs or hit them every day almost with really brief periods of weakness. And in that environment, if you're an issuer, you have to be taking advantage of that. But the reality is like, for Canada, this is where the rate forecast will come in, but the data have been as bad as they could possibly be almost. So we got one good job number, great. That followed 6 weeks of terrible data. If you look at something, it's called the surprise index for Canada, so the extent to which the data surprise on the upside or downside versus expectations. It was as negative as it has been almost in the past 15, 20 years, in the past couple weeks or so until that good job number. And you are in an environment where Canada almost is as bad as it can be. And rates are here. So if things can only seemingly get better from a data perspective, not that I necessarily think they'll stay sustainably better, but better from here, are rates really going to fall much further? And the answer is probably not. It's going to be really challenging. And add oil to that equation. Oil's at $90. Is oil going to go back to like 80 or 70? And the answer to that's, I think, unambiguously no for a bunch of years. And so you have higher oil prices, I'm not going to say in perpetuity, but for a long period of time. You have almost the most negative data run you could possibly get, almost, unless we get a really negative trade outcome. It just doesn't seem like things will get that much worse here. And rates are still not all that low. We're trading toward the bottom-ish of the range that we've traded for the past 6 months or so, most of this year. It's been some deviations there, but mostly there. And this is when you take advantage of that. I've been telling the issuers that I speak to that issue as much as you possibly can while you can. Spreads won't necessarily stay here. Rates won't necessarily stay here. And if you look further out on the forecast, so we have no rate hikes from the Bank of Canada this year, and the forecast is a little murkier further out, but the risks tilt, I think, pretty quickly to the upside whenever we get a trade deal. Whenever that comes, it's going to unleash a lot of business investment. That's going to drive a lot more growth for Canada. And then on the other side, you also have the government driving forward with these major projects. And there is a big investment conference in September that Prime Minister Carney has put together with global investors and our pension funds and all these. It's hard to believe we're not going to get something out of that. And so if you get progress on these big projects that will drive growth for Canada and you get a trade deal, that's a much better growth backdrop for 2027. And so you could get higher rates through that period. And then also consider just kind of global rates and the global backdrop and inflation generally. I have trouble believing that most people think global inflation is going to go lower anytime soon. Canada's in a period where we have some cyclical downward pressures on inflation, but when growth improves, that's going to change, and you'll get some cyclical upward pressure in addition to the global upward pressure, in addition to energy prices, one thing after the next. And so it's really challenging to see rates going a lot lower from here. And so, yeah, you hit the market while you can, and hopefully it's after some positive headlines that bring rates down, and that makes it a little bit more attractive.
Right. And from the issuer side, I think from what I'm hearing from your comments, if you have debt outstanding and it's variable rate debt, it might be a good time to actually lock in here.
Yeah, I would do it opportunistically. I think when you do get those decent periods, a good run in rates, because we do trade up and down. You get a 20, 30 basis point rally. Yeah, you take advantage of that, very much so. Earlier this week, my colleague showed me her mortgage rates, and it was like a 3-year and a 5-year, and I was like, man, both of those rates are not great right now. And you probably want to get it 20, 30 basis points lower, and then you definitely want to do that. And that's the kind of market we're in. You do get that level of volatility, and take advantage of it. I think that's what you need to do. It's harder as a consumer because we don't move mortgage rates that fast, but as an issuer, things do move that quickly. The market does matter. The day-to-day moves do matter. If we get a little bit of a rally here,
take advantage.
Very much so, yes.
Yeah. And I think that's what we're seeing a lot from the issuer side as well, is clients are on the sidelines watching the market quite closely because everyone wants to hit a low. It's very difficult to actually predict when that'll happen. We're talking to clients about option strategies, give them a little bit of flexibility, but protection as well. The participating swap is a product that we're showing to a lot of clients. They can hedge 6 months forward for a 5-year period. If rates decline within that period, they can take advantage of that decline. It can help. It's not a one-size-fits-all, but it's part of our active client discussions because locking in does provide protection, but can feel limiting if markets move more favorably. That wraps up today's episode of the Hedge Report on Markets Plus. Thank you, Ben, for sharing your insights. For our listeners, we hope this helps you navigate the uncertainty in interest rates and make informed decisions for your business. Stay tuned for future episodes where we'll bring in more experts to discuss strategies and opportunities across markets. Until next time, thank you for joining us.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.